You would also sometimes see agents that miss this all up too, because they'll say, "Oh, you need to replace your roof. You replace your roof every 15 years, or you can't get insurance, or every 10 years." That is not true. I never advocate removing a roof and replacing a roof that's in good condition that's got plenty of useful life.
Hello, thank you for joining us for Policy Party. I'm Negar Sharifi, joined by Phil Masi. Today we want to talk a little bit about Fannie and Freddie Mac. The bane of our existence, and likely yours too. There was a pretty large release that was blasted out this week about some guideline changes. So today I'm going to ask Phil to go over some of those updates and other important lender requirements that affect your associations and owners. Phil, let's start with the great news that just came out from Fannie and Freddie. This is something that an organization that we are a part of. Phil and I are both CIRMs, a part of CAI, that stands for Community Insurance Risk Management Specialists. Basically, yes. We're insurance dorks. So we've been pushing for this, our organization, with Fannie and Freddie. And what's the big one that changed, Phil?
And I'll get to it and then explain why it's important. But the Fannie and Freddie guideline that changed is that condo associations, for their roof systems, we were having issues where some of the carriers didn't want to insure the roofs for replacement costs. They wanted to insure them at actual cash value if the roof was past a certain age. So actual cash value means the carrier is paying the depreciated value of that roof covering versus a true replacement cost. So if you got a 20-year-old roof, you're getting a depreciated amount of that roof number. Fannie and Freddie did not like that. They did not want to see any actual cash value wording. That has officially changed now. So they will now accept actual cash value wording on the roof coverings. So that's recent, as of literally this weekend. So that just happened.
And that's big.
And that is big. Now, what I thought we'd take the opportunity to do, though, is explain lender requirements, because I think that's maybe one little thing that's changing. But a lot of folks that watch this don't really understand, what the lender issues are for community associations. So, many of my clients and many of our community associations don't actually have lender requirements themselves because they don't have loans, right? So the associations, some of them do. They take big loans and do big construction projects, engineering, things like that. But most of the time, there's no loan in place the association's responsible for. So when they hear lender requirements, like, well, what's that about? Well, what you were mentioning, the bane of our existence, it's really lender requirements of unit owners, where the unit owner has a mortgage on their unit and their bank wants to see the insurance that the association has in place to make sure it's compliant, so that they do not force place insurance coverage on that unit owner. So if a unit owner, like if you're an association, you say, hey, you know what, we're not buying any insurance. We don't care. We're only worrying about ourselves. What happens, again, it's a bad idea, but for a unit owner that lives there, they're going to then get forced placed insurance coverage through their lender. And that cost will be exponentially more than it would be if they were just getting the insurance at the share that they would be responsible for through the association. So that can create a lot of issues, right? It could prevent sales in your association. So you get people that say, hey, I couldn't sell my unit because the association doesn't have what they need. I'm going to bring a suit against you for my losses here. Or, someone obviously gets forced placed the coverage and then brings suit against the association because it's costing them a lot of money or whatever that may be. So, a lot of people think they buy insurance to comply with their documents, which they do, or by, statute 718 or 720, which they do. But really it's to help your unit owners be able to buy and sell units there, because they need to see that insurance is compliant. And so one of those things was the actual cash value on the roofs that used to trip us up in certain scenarios. But other things would be like appraisals, which we've talked about in other episodes, where, the appraisal wasn't updated enough, right? So you're supposed to update it every 3 years in the state of Florida, and you could see an association with like a 5-year-old appraisal, and the lender would have an issue with that. They'd want that to be updated to a current appraisal, or flood as well will happen.
So Fannie does still have a requirement on the books that is almost impossible for any insurance agent anywhere in the U.S. to get, and it's 100% replacement cost value.
It's just the terms they're using.
It's the term they're using. But what that basically means is that regardless of how much you're insuring the buildings for, the carrier will give you as much money as needed to replace it. Well, that coverage doesn't really exist in practice. It's like
commercial side.
Commercial side, you can't get it. However, a workaround with Fannie and Freddie is they'll accept an appraisal. And as long as the limit on the appraisal matches the limit on the certificate,
Yep, for the buildings.
For the building.
And so you also see issues with deductibles. So they want to see deductibles under 5%.
Yes.
Just stuff like that will come in. And then wind coverage. In Florida, you'll see some associations don't purchase wind, which of course everybody should be purchasing wind. But you'll see scenarios where an association may not purchase wind because they have really, really old roofs, some sort of structure issues, can't afford it. Any type of excuse kind of come up with. But that'll be a problem too. So if you're not buying a major coverage that the carrier requires, either your deductibles are too high, not buying coverage, any coverage or certain coverages, appraisals out of whack. Those are all issues why the lender may push back or force place coverage on a unit owner. Flood insurance, I just kind of mentioned it before, but if you're in a special flood hazard zone, so an A, AE, V, VE, same thing. Those unit owners need to show the association is buying flood coverage in order to satisfy their lender, because as a unit owner, you cannot buy flood insurance for the building. That has to be done through the condo association. So these are all things that can trip up, a situation, make the loans more difficult. The good thing is with the Fannie and Freddie changes on the roof valuations, granted, I wish this was like this 3 or 4 years ago when it was a real problem. Right now, most of the renewals we do, we're able to negotiate replacement cost, and we're not worrying about that anymore. But that does still come up every so often, depending on the specs of the account. So great that they fixed it. It was something we lobbied and pushed for. It took forever, but it got done. So
also, I have some associations that they have older roofs, and they're in perfectly good condition, these roofs. And they rather actually, as a board, take the actual cash value and save money on the premium rather than be forced to replace their roofs just so they could get replacement cost value.
Yeah, 100%. I think that it gives more power to the association, because I used to argue, why can't we show a reserve study? So if you had a reserve study that showed that you were adequately reserved to replace your roof, so you had the money sitting in a reserve account for those roofs and you were in compliance with your reserve requirement from the study, why should the lender care if it's ACV? Because even if you got no money for the roof, which again, you should still get something from insurance. You have the money sitting there. The money's sitting there anyway, but nobody would ever take the extra step at the lender or the bank. This is the problem with, there are a lot of things we can get into there, but that was frustrating because I feel like there's associations that are doing everything the right way. You would also sometimes see agents that miss this all up too, because they'll say, oh, you need to replace your roof. You replace your roof every 15 years or you can't get insurance, or every 10 years. That is not true. I never advocate removing a roof and replacing a roof that's in good condition that's got plenty of useful life. If you're doing inspections every year and your roof's in good condition and it's got plenty of useful life, I'll never suggest you rip that roof off to replace it just for insurance. But you want to be able to show proof that the roof is in good condition and does have useful life. I think if you run reports on your roof and you can't show that, that's a problem. And the board needs to tackle that. Because I'll tell you, you look at a 10-year-old roof, buildings right next to each other, depending on who put it on, the maintenance that was done to it and everything else, those things may not be equal at all. You could have a 10-year roof failing and another one that's got 20 years left on it. So really, important to know the value, or know basically the useful life and the condition of that roof.
And on a parting note, Fannie and Freddie and these different lenders can be incredibly difficult to work with. But the good news is we have a lot of experience in this office and a pretty good team. So we're usually able to work around those problems and find a solution for our boards. Well, thank you, Phil, for filling us in today on Fannie and Freddie and lender requirements. Thank you for joining us today for another episode of Policy Party. I'm Negar Sharifi, joined by Phil Masi.